Animal spirits, how human psychology drives the economy and why it matters for global capitalism. By George A. Akerlof and Robert J. Shiller. This is a book summary. What if I told you that the economy isn't just about numbers, interest rates, and policies, but about emotions, confidence, and even storytelling? What if I told you that Wall Street isn't just run by cold, hard data, but by hype, fear, and even superstition? What if the biggest financial collapses in history weren't caused by logical miscalculations, but by something deeply human? Our emotions, instincts, and beliefs. The roaring stock market of the 1920s, the dot-com boom, the real estate frenzy of the 2000s, all of them fueled by one thing: animal spirits. And today we're pulling back the curtain on the forces shaping our financial world, inspired by the mind-blowing ideas from animal spirits. How human psychology drives the economy by Nobel Prize-winning economists, George Akerlof and Robert Shiller. Why do economies suddenly crash when everything seems fine? Why do housing prices skyrocket only to collapse a few years later? And why do people make completely irrational financial decisions over and over again? If economists only looked at data, none of this would make sense. But if you look at confidence, fear, and the stories we tell ourselves, everything suddenly becomes crystal clear. It's time to uncover the real driving force behind the economy, not just numbers and policies, but your emotions, your beliefs, and even the myths you buy into. Welcome to Animal Spirits. Chapter 1: The Invisible Force that moves the economy. You've heard it before, people are rational decision makers. We act in our own self-interest, weighing costs and benefits like human calculators. At least, that's what traditional economic theory tells us. But here's the truth: we are not rational creatures when it comes to money. If we were, we wouldn't see market bubbles inflating beyond logic, only to crash into chaos. If we were, thousands of people wouldn't rush to buy lottery tickets, hoping for a miracle, while ignoring safer investments. If we were, banks wouldn't lend recklessly in good times, only to panic and stop lending completely when things go bad. But we do. That's why Akerlof and Shiller introduce a powerful concept: animal spirits, a term originally coined by legendary economist John Maynard Keynes. Animal spirits are the emotions, psychological biases, and gut feelings that influence financial decisions at every level, from a single person's impulse to buy a house, to a corporate CEO's decision to expand, to a government's response to an economic crisis. And here's the wildest part: these psychological forces don't just shape individual choices, they drive the entire economy. Think about it. When confidence is high, people borrow more, invest more, take more risks, and the economy booms. But when fear takes over, spending dries up, businesses cut back, stock markets collapse, and suddenly we're in a recession. So if you're wondering why markets can rise and fall unpredictably, why people panic sell their stocks, or why economic crises keep repeating, it's not just about logic. It's about emotion. And guess what? There are 5 key animal spirits that determine whether an economy thrives or spirals into disaster. Let's break them down. Chapter 2: The 5 hidden forces controlling your wallet. 1. Confidence. The boom and bust cycle. Imagine this: it's 2006, real estate is the hottest investment in town. Your neighbor just flipped a house and made a $100,000 profit in 6 months. Your coworker brags about refinancing their home to buy a second property. The news is flooded with stories of skyrocketing home values, and banks are practically begging you to take out a mortgage. And then, suddenly, it all collapses. That's because confidence is contagious. When people believe the economy is doing well, they invest, spend, and take risks. But when fear creeps in, confidence flips overnight, and suddenly, no one wants to buy. This explains why recessions often come out of nowhere. It's not just numbers on a spreadsheet, it's psychology at scale. Akerlof and Shiller describe this as one of the most powerful forces driving the economy. Confidence multiplies itself. When investors, businesses, and consumers feel optimistic, They fuel economic expansion. But when confidence collapses, panic spreads like wildfire, leading to downturns that no one saw coming, because they were looking at spreadsheets instead of human behavior. The 2008 financial crisis, housing prices skyrocketed because people believed they would always rise. But the moment doubt entered the market, everything unraveled, mortgages defaulted, banks collapsed, and millions lost their homes and jobs. Confidence is like a roller coaster, thrilling on the way up, terrifying on the way down. And yet people keep lining up for the ride. 2. Fairness. Why people accept or reject the system. Have you ever worked your hardest, only to find out a colleague doing less makes more money than you? Have you ever seen CEOs rake in billions while their employees struggle to pay rent? Have you ever wondered why some people are willing to risk their lives in mass protests, demanding higher wages? Fairness is a hidden yet fundamental force in the economy. People don't just work for money, they work for justice. Akerlof and Shiller argue that when people feel they're being treated fairly, they participate in the economy. They work hard, contribute to businesses, and spend their earnings. But the moment they feel cheated, whether by stagnant wages, skyrocketing living costs, or unethical corporate greed, they start rejecting the system. That's why minimum wage debates and corporate scandals aren't just political issues. They're economic ones. That's why when workers feel exploited, they go on strike, quit their jobs, or stop putting in effort, creating economic slowdowns. When fairness breaks down, so does the economy. 3. Corruption and bad faith. Why people cheat the system. What happens when the people controlling the money decide to play dirty? 2008, the banks collapsed, and who paid the price? Enron lied about its profits, and thousands of employees lost their retirement savings. Bernie Madoff scammed investors out of $65 billion, ruining lives. From Ponzi schemes to shady lending practices, corruption has the power to wreck entire economies. Akerlof and Shiller explain that corruption isn't just about a few bad apples. It's about a system that allows, encourages, and even rewards bad faith behavior. Think about it. Banks made billions from risky subprime loans, knowing the risks. When the market crashed, they got bailed out, while everyday people lost their homes. When institutions lose the public's trust, markets suffer. When people believe the system is rigged, they stop playing the game, leading to long-term economic stagnation. Bad faith decisions don't just hurt individuals, they can sink entire countries. 4. Money illusion. Why we misunderstand value. If your salary doubles but prices also double, are you actually richer? Most people would say yes, but they'd be wrong. This is called money illusion, our failure to understand inflation. Akerlof and Shiller explain that most people don't think in terms of real value. Instead, they look at the numbers in their bank accounts and salaries, ignoring the hidden costs of inflation. This is why workers demand raises that barely keep up with inflation, but think they're getting richer. Retirees panic when their life savings seem big, but can't actually buy much. Governments print more money, thinking it will help, but end up making everything more expensive. The 1920s German hyperinflation crisis, people needed wheelbarrows full of cash just to buy a loaf of bread. The modern $10 cup of coffee? That's money illusion at work. The more we misunderstand inflation, the worse economic policies become. 5. Stories, the narratives that shape the economy. What if I told you the economy isn't just about numbers, it's about stories? The American dream? Anyone can succeed if they work hard enough. Bitcoin is the future, so buy now before it's too late. House prices always go up until they don't. Akerlof and Shiller argue that economic trends are fueled by the stories we believe. Think about the 2000s housing bubble. The dominant story was, buy now, or you'll never own a home. So people poured money into real estate until the story changed to, oh no, the market is collapsing. Result, the worst financial crisis since the Great Depression. Narratives shape confidence, investments, and entire industries. And when stories shift, markets follow. So, what does this mean for you? Every time you invest, save or spend, you're being influenced by animal spirits. The government and central banks must consider psychology, not just numbers, when making policies. Financial crashes will keep happening, because people never learn. But if you understand these forces, you can make smarter financial choices and avoid falling into economic traps. What do you think? Are people rational about money, or are we all just driven by emotion? Drop a comment below. Print more money? Cut interest rates? Bail out banks? Every time the economy crashes, governments scramble for quick fixes, throwing money at the problem like it's a glitch in a machine. But here's the problem. The economy isn't a machine. It's made of people. Akerlof and Shiller argue that economic policies have failed time and time again because they ignore the human psychology behind financial decisions. You can pump trillions of dollars into the system, but if people don't trust the market, they won't spend, they won't invest. And the economy will stall again and again. Look at 2008. The government bailed out the banks, injected billions into the financial system, but trust in Wall Street and the housing market was shattered. People held onto their cash, businesses cut jobs, and recovery took years. Look at the Great Depression. Franklin D. Roosevelt rolled out massive stimulus programs, but it wasn't just money that turned things around, it was the restoration of confidence. FDR's famous words weren't about economics, they were about psychology. The only thing we have to fear is fear itself. And today, we're facing the same cycle. If we don't fix the root cause, the trust, the corruption, the misunderstandings of money, we're doomed to repeat history. So what's the solution? Akerlof and Shiller outline 3 key changes. 1. Stronger regulations to prevent corruption. Every financial crisis has one common denominator: bad faith actors taking advantage of a broken system. The 2008 housing crisis, banks made billions selling risky loans, knowing they were doomed to fail. Enron's collapse, executives manipulated numbers while employees lost their life savings. The dot-com bubble, companies lied about their profits, and investors believed them. Without smart regulations, history repeats itself. Markets need rules. A good economy is like a great soccer game. You need referees to enforce fair play, or else it's just chaos. 2. Public trust initiatives to rebuild confidence. Imagine walking into a bank tomorrow and hearing a rumor that it's failing. Even if your money is perfectly safe, what would you do? You would panic. You'd withdraw your savings, and so would everyone else. That's what happened in the Great Depression when banks collapsed, not because they were actually bankrupt, but because people believed they were. That's what happened in 2008 when businesses stopped hiring, not because they had no money, but because they feared the worst. Confidence is everything. Governments need to focus not just on policies, but on communication, rebuilding trust in the financial system so people don't react out of fear. Because when trust disappears, the economy disappears with it. 3. Better economic education to stop money illusions. Let's face it, most people don't understand inflation, interest rates, or investment risks, and that makes them vulnerable. Ever wonder why people rush to buy houses during a bubble? Or why they panic sell stocks at the worst possible moment? Or why some people think they are getting richer even when their money buys less? Money illusion is real. People focus on the number in their bank account, not the real value of what it can buy. Akerlof and Shiller argued that financial education should be as common as learning math or science. Without it, people keep making the same mistakes, leading to market crashes, personal bankruptcies, and economic downturns. Imagine if everyone understood how inflation works, how to invest smartly, and how not to get scammed. Imagine a world where economic crises were preventable because people weren't blindly following bad financial advice. The best economic policy isn't just about the government. It's about making sure people know how money actually works. Without these changes, we're trapped in a loop. Boom, bust, bailout. Hype, crash, repeat. Confidence, corruption, collapse. Unless we rethink how the economy really works, we'll be back here in 10 years, analyzing another crisis, another bailout, another round of economic suffering that could have been avoided. The question is, will we learn this time? So, next time you hear someone say, the economy is crashing or we're in a boom, ask yourself, is it really just about numbers? Or are animal spirits running the show? Because whether it's confidence, fairness, corruption, inflation, or the stories we believe, the economy isn't just a math problem. It's a psychological roller coaster, and the only way to ride it safely is to understand what's driving it. So, what do you think? Is the economy based on logic, or is it all about emotion? Drop a comment below. And if you found this breakdown mind-blowing, hit that like button, subscribe for more deep dives, and let's keep unraveling the hidden forces behind the economy together. Stay smart, stay skeptical, and remember, money isn't just about numbers. It's about people.